the US in UTC -7 and Singapore at UTC +8, a big time difference. So it's 3 in the morning where I am, and I'm hoping it's something like 9 o'clock in the evening, or 5 o'clock in the evening in Singapore, and 5 p.m. Okay, great. So hopefully you, hopefully you've enjoyed a nice, wonderful weekend day, and you're spending some time here to try to get a little bit of an update on what we can expect to see in the market ahead of us. And I get to be the one to share some information that might help you anticipate some things that you can trade with. We got 7 o'clock in Australia. Is that it? Yeah. No worries. Happy to be here, guys. Yeah, thanks for the appreciation there. Yeah. I hope that what I've got to share with you is going to help you be prepared for the week to come, because there is a huge opportunity ahead. I think that you will see the week start off slow, but see some very significant moves in Thursday and Friday. And let me show you why I think that's the case. I can get my screen ready here and share with you a couple of charts. We're going to start with the dollar index on a 5-minute time frame over the past week, as the Fed announced what they were going to do with interest rates. And let's look at how that played out in the kind of detail that I think will be useful. There we go. We're just going to look at regular price action here for a second. And I want to show you something. Okay, now then, let me get my screen shared. There it is, that one. Okay. This is a look at the DX1 futures, the dollar index. So if you're trading the futures on the dollar, not the Euro USD or something like that, right? Just the dollar futures. Then this is what happened when the Fed made their announcement that they weren't going to change rates. A lot of people were nervous that the US Federal Reserve might actually continue raising rates by 1/4 of a point. Nobody expected them to raise a full 1/2 of a point, although there was a tiny little bit of nervousness, like, who knows, these guys could be totally crazy. But the best case scenario was they weren't going to change. Certainly nobody thought they were going to cut rates or anything like that. Nobody entertained that idea in a serious way. So when the news came out that on the day before, that the CPI numbers, Consumer Price Index numbers, were showing inflation to be trailing in the US over the past trailing 12 months to be 4%. That was a big surprise, because economists were forecasting 4.1%. Even that was a kind of aggressive, highly optimistic forecast, because inflation in the previous month had been running at 4.8. And so, a 0.7 drop just in 1 month for the, annual looking back rate of inflation. Hey, just a year ago, inflation was in the 8s, right? 8% in the US. And so the idea that it was going to drop from 4.7 to 4.1 was a very optimistic forecast. But in fact, the market came along and beat that with 4.0. So that left everybody thinking, wow, maybe the Fed really feels like they've done enough. Maybe they won. They curtailed inflation. They got it right. Maybe the Fed knows what they're doing. Let's see what the Fed thinks. Because if the Fed thinks, we don't have to raise rates anymore, that'll be our indication that they think, yep, we're in good shape. And that is exactly what happened. So right at that moment, when they came out and said, we don't have to raise rates anymore, then that's what happened. A huge jump up. Now, if you take that 5-minute bar and you look at just where the price goes at its highest and at its lowest, and then you extend these out, they become very important indicators. And this is true almost any time you look at the Fed information news. I mean, it's also going to be true for European Central Bank and others, that if you sort of look at the first 5 minutes, sometimes people like to look at the first 15 minutes, and first 15 minutes would have put us a little higher, like right here. But you can see the activity really doesn't change that much, right? Either way, 5 minutes or 15 minutes, this becomes a very important level price-wise going forward over the next day or two. And then this one here, of course, is the same thing. It's the same as 15-minute chart. Now look what happens here in this 15 minutes at these extremes. This becomes a real serious resistance level going forward. Price takes off on the dollar futures, comes all the way down, not all the way, almost all the way down, but then trends higher, right? And then when it gets up here, it has a hard time doing anything more, right? This is a real indication of weakness. And then when the markets begin to open here, they retest that and just start heading down. I mean, do you know just by looking at this that that's going to happen? You don't, but it's a good bet. See, a good trader doesn't pretend like they know the future. A good trader takes a moment, an indication of some kind, and prepares. Well, I mean, look at it this way. What if you'd have said, oh, well, okay, that I know is going to be resistance going forward. I know the future. I know it's going to be resistance. Okay, and then I started going short on this. Well, I might have shorted here at the bottom of that, and I'd had to wait a long time for it to finally play out, right? It all depends on how much I bet and how much patience I have and so forth, right? You don't really have a clear way of knowing that it's going to turn a certain way this time. But here, what we do is we watch the minutes pass. We realize, wow, this looks like resistance, and it takes off and it comes back up, and we think, okay, if this shows us that it's resistance, and the next time it hits that level, I can prepare to trade a reversal. What kind of a setup am I going to take, right? Now, most people like to be right. Most people like to win on, a given iteration. The easiest way to do that is to make a real loose stop loss and a really tight profit target. That almost guarantees that you win a majority of the time. What I mean is, let's suppose you risk 50 pips and you take 25 pips profit. Simple as that. Doesn't matter what currency you're looking at. But Euro USD here we're talking about. If you said, I'm going to set my stop loss at 50 pips, and if it runs in my favor, 25 pips, then I'll take profit. Just randomness should tell me that I would win that 67% of the time. What's the problem? The problem is that when I lose 50 pips. When I win, I only win 25, right? Now, you can reverse that and say, okay, I'll only risk 25 pips, and then I'll try to take 50 pips and, see what I can get, because then I'll get 2 to 1. So when I win, I'm winning double size, right? Well, you're probably likely to win that thing about only 33% of the time, just on sheer randomness. Okay, so neither way over many trades makes you a lot of money. The way that you make really good money is that you get a small edge in your prediction. You come up with some particular market anomaly that reoccurs and tells you, hey, I have a slightly higher than 50%, 50-50 chance, going a certain direction, and then you just bet that most of the time. But there's another way, and that is totally independent of whether or not you've got a good indication. That is just the win size. If you set up a trade where you're going to try to risk one and make two, or risk two and make one, either one, what if what you made was bigger than what you were planning, right? So if I risk two to make one, but what I actually make is 1.5 or 2 or 3 or 5, right? 5 times the amount of, or if I risk one to make two, but instead of making two, I make 3 or 4. Hey, even if I can only be right randomly, but I'm winning more than I would by randomness, that's an edge through win size. So I can either have an edge by winning by my win frequency, my win rate, or I can have an edge by win size, or what's best of all is to do both, right? Now, what about this past weekend, right? Well, or this past week, if you have been watching here and you saw this in your trading the futures, then when you hit resistance right at that point, you could have said something like this. Okay, I am going to set a stop loss right there, just, one tick higher than it has been up until that point, right? That is going to be my line in the sand, my stop loss. And I'm going to try to get in, let's say something like right there. And I'm going to change that to blue. All right. So my entry is going to be at this level. Why? Well, because once I see, oh, it hit that, starts coming down, and then I see the next candle shows a little bit of follow on, right? That's where I want in. Okay. And let's suppose then I am going to try and, no, not text. Let's just do this. I want to try and say, okay, that is the distance to my stop loss. Okay. Well, then now what I want to do is try and determine where my profit taking target should be. If I just want to do a 50-50 trade, I could just say it's right here, right? Risk one to make one. But what if I said instead, I'm going to try to just do as tight a stop loss as I can, risk one, try to make two. Yeah, I know I'm only going to get about 50%, 33% right. But why would I risk one to make two, something, twice as far away? Here's why. Because if I look at what has happened in the past, based on these, that 15-minute range coming out of the Fed announcement, I know that the target of the other side of the channel is clear down here. And my risk one to make two target isn't even there yet. So here's my huge opportunity, right? I get in and I make this trade going short. And if it goes there, I get out. But if it goes down, I don't take the profit here. Remember, I'm trying to increase my win size. I just have an alert. And when the alert hits and says, yep, you're there, like, great. I'm going to move my stop down, maybe about halfway at first or something. And then I'm going to trail it as I go. So, for example, here it comes down, comes back up, starts going down again. And by the time I get all the way to the bottom, I could actually move that stop loss right to there, just, the highest point. And then when it blows through the bottom of the channel and comes back up, makes this other high, and comes down clear to this low, I can say, all right, that's fantastic. Now my stop loss is there. And at this point already, I'm making more than two. This is almost 3-1. And look where that goes. That just goes and goes and goes, right? So this is one of those really nice circumstances where I can make a bet that tells me, I can expect to be wrong. I don't have to be right this time. I could go ahead and set this trade up, not knowing the future, but knowing that if I do the same trade 10 times, it's going to allow me to win a bigger size than I would normally win just by randomness. You get all that? That's kind of the huge and important thing that we're going to look for in the coming week, right? So, for example, let's look at the euro. Let me see if I can line this up over the exact same time frame. I mean, here's what's going on. US inflation data is dropping, and the Fed looks like they don't want to raise rates anymore. And so it's a good possibility that the US will continue to drop. The inflation will continue to drop in the US. And that maybe even the Fed will either not raise rates or they will bring them lower. That will decrease the demand for US dollars. The currency that has the higher interest rate and has the more stable economy together, those two things tend to increase the demand, which is why over the past little bit you see the euro gaining ground over the US dollar, because the US dollar is going to at some point stop paying as much interest as it has been. But the euro, the ECB says, hey, we're still tightening. We have to keep raising our rates. So the euro is going to raise rates, and the dollar is not going to have its rates raised. Guess what? There's going to be more demand for the dollar, or for the euro. Sorry. So in the euro USD, you could expect for the next few months to see an upward trend in the euro over the dollar, right? Well, that's what you would expect. And yet, look at this MACD down here and see what's building. Long, slow, but kind of scary. We're getting higher highs on the US dollar or on the euro US dollar, and we're getting lower highs in the MACD. This is, going clear back to November 2000 or 2022 up until now, right? So this is a very long term. It's like somehow the trend is going up, but it's like weakening as it goes. It's going up slower. Is it possible that it will turn and head down? That doesn't seem likely, and yet over the next several days, that is something we're going to want to keep an eye on. Now, in the next week, what does that mean? It might mean that there's going to be weakness in the euro in a surprising way, and if somehow news comes out negatively, you could see a shock in the euro, just sort of a short term, 4 hours to 48 hours kind of shock in that price that you might be able to take advantage of in the way I just described for the Fed announcement last week. So either looking to play the euro to the downside, or if you think, no, Gordon's crazy, I'm going to play the upside on the euro. Fine. Just we'll keep that tactic in mind. But let me just sort of do the 5-minute chart here and see most recently what's happened on the euro USD, and you'll get the kind of idea of what I'm trying to say here. See if I can kind of compact this price activity. There we go. And let me move back a little more. Yes, okay. So hopefully this won't start moving on me. Okay, right here, then this is sort of the upside down. We were looking at the dollar. This is the euro versus the dollar. So now we're looking at something that is upside down compared to what I was just showing you, right? Here's the sort of 15-minute high and low after the announcement. And you see, it's just the mirror, upside down. And what we see is, hey, it didn't come all the way back, but once it came to this line, unlike the last one, unlike the other one, we never even, tested this line. If I were looking at this at the 5-minute level, I'm wondering if I can move that. Probably the second one. There we go. 1.8. That's not the one. This is the one I want. Edit this one. Yeah. Let's move that up to the 5-minute level. 8070. 8070. Ah, beautiful. All right. It's not exactly the end of the 5 minutes, but it's close enough. So unlike the 15 minutes, which worked well on the dollar, here you can see on the Euro USD, it was just the 5 minute was the thing that indicated instead of resistance, this time it's support, right? Here it is. See how we get down here, and at this level, if you know, maybe even a little bit lower, you see the price sort of stops and hits support all the way through. So if you say, all right, well, this is support, I want to try to figure out when I can go long, right? If in fact you had been watching here and here, and you get to this point and you say, all right, there's still support, I'm going to go long from here. Where am I going to try to go long? If I were to just say, I don't want to draw too many lines on this chart, but well, we'll just make another horizontal line. Let's suppose here I was looking at this and I said it bounced up, and finally we got above that level with a little bit of follow on. So right in here is where I wanted to make my entry. And then that would mean my stop loss would naturally be down there. Let's see if I can change that to be objects list, horizontal line. Yeah, that's the one. And we'll change this one to red so you can see this. Oh, yes, I got it. Okay. So if here I made the entry and then I said down here, that's where I want to put the stop. You can see that I've got myself set up for about what is that, 10, 13, or I mean 10 or 11 pips, right? Counting at the fourth and fifth, or you want to third and fourth digit. On the fifth digit, you know, you'd call it 10 times as many, but depends on how you count it. I'm a little old school. That's 10 pips for me. So if I said, okay, I'm going to risk 10 pips this way, I'm going to try to get 20 going up. I'm targeting, you know, somewhere in this level right there. And let's see if I can change that one to green. Just fatten it up a little. Yeah, there we go. All right, so there it is. That's my trade setup. I'm going to try to enter here, stop there, and try to go there. But as you can see, I could do much better than that. I could get a larger move. Now, this one here doesn't go all the way up. It kind of goes up and comes back, right? So either I'd make that 2 trades, or I'd say, well, I'm fine. I'm just going to play this one then. Great. You play the break of that, and you have a stop loss of 10 or 15 or 20 pips, and you know you've got a whole lot more than that takes off. You don't know that that's coming. You just prepare yourself to trade for bigger gains than what you planned for. All right. So just demonstrating that it can be done. What are the events coming up this week where we might be able to make one of these trades and sort of see the days that give us support and resistance ahead of time, and then the days that break out and make these big trades? Well, that's why I'm really excited about this week, is that I feel like this is going to set up, this coming week is going to set up in this just textbook way I've been showing you. Okay. Okay, I'm going to get my chat window up here so that as I start going through this, if you have questions, you can just feel free to rattle them off. All right. Now, last week, we had the U.S. inflation numbers, and we had the U.S. PPI come out. and we had the Fed statement, right? This week, it's going to be all about the follow-on from that and the expectations from that. There's also going to be a lot of information about the Swiss National Bank and the home sales. Yeah, this number here in the U.S. existing home sales. Fed chair is scheduled to testify in front of Congress, and also the one of the FOMC members, Waller, who made a lot of statements about, hey, he feels like there's conflicting data, don't know for sure. That's going to happen on Thursday. So look at this. We got a bank holiday, U.S. bank holiday, on Monday. Tuesday, we don't have any particularly big data. There's a lot of little news data, but probably not stuff that's gonna. Well, it's not orange or red by Forex Factory standards, right? So they're not expected to move the market a lot. Probably be a little quiet ahead of what, at least in the currency world. The U.S. stock market could move just because it's had some pent up activity. But you've got China having a bank holiday all the way through Thursday. Well, starting at Wednesday and Thursday. And so, you've got Britain giving out CPI data on Wednesday, and then you've got retail sales in Canada. I feel like the early part of the week is stacked with a lot of sleepy data, a lot of low impact news reports as far as the currency in the Forex world is concerned. What that means is the first 3 days of the week are likely to establish the ranges, whatever the high and the low is for the entire 3 days. Or if you look at key news events and you see a big bar because of the news event, take a look at the high and low of the first 15 minutes after that news event, and then extend them out. And then get ready for Thursday, right? That's the play. So if we see a sort of slow and range-bound activity for the first 3 days, Thursday and Friday may break it open. Whichever way it breaks, it could keep going quite a bit. I don't know, high or low, right? Maybe the euro will drift higher, but then Thursday or Friday, something will happen and the euro will drop, right? A scenario like that could play out. But a simple look at these resistance, look at these support lines from where the news is going to leave you, could create that kind of situation. Now, I highlighted existing home sales, and yeah, great question, Catherine. I'll come right there in a second. I looked at, I mentioned real estate and home building. One of the stocks, if you follow U.S. stocks like I do, an important stock to follow is XHB. It is the ETF which tracks the home builder index. It's sort of the leading edge of the real estate market because it's the retail home builders, the people, large companies who build homes and then have to sell them. And they take a lot of risk because they'll build these homes at spec. And then when the market's rocking and rolling, people come and buy them before they're finished, and they even have bidding wars on them and so on and so forth, right? Well, that's not where we are right now. With interest rates higher and with people kind of, a little more worried about inflation, a little more worried about their job security and so forth, then you have the market having softened over the past 5 or 6 months. But unlike what a lot of people have predicted, it hasn't fallen, the bottom hasn't fallen out. And it's not like people are, heading for the hills and oh, forget it, I'm not going to invest in real estate anymore. It's not like that. You still have a lot of companies making money. You still have this stock trending higher. And I think it's going to be really key to keep an eye on the trend of this stock. If somehow that stock turns around and starts trending lower, or if you see big red candles begin to appear on this stock, then that's really going to be an indication that the U.S. economy's the U.S.'s economy is headed for trouble. And it may not be coming immediately, but it might, eventually 2, 3, 5, maybe even 12 months play out kind of like it did in 2007 and 8. We just don't see that. A lot of people say, oh, here's the next big market crash. It's, at least in the real estate world, it's not there. It is not even flickering. The real estate world showed severe weakness an entire year or two, depending on when you count the top of the 2008 recession being, right? It showed severe weakness for a whole year or two. And before that, and people could see that kind of part of it coming. They didn't know exactly what to do about it. Michael Burry, the famous guy in The Big Short, right? He started betting against the US housing market a full 2 years before it turned, which is why it was so hard for him and his investors, because they kept losing money for those 2 years until all of a sudden, oh, now you're right. And it paid off huge. So that's the trouble with the contrarian, right? Getting the timing right is everything. It's so very difficult to do. Instead of being a contrarian so much, if you are someone who says, I think this is a big move, then you can do exactly what Catherine here has suggested. So Catherine in the chat says, Gordon, how about a 1-for-1, take 50% off, and then do what you did in the DXY futures trade? Okay. So some people feel like it's psychologically difficult to stay with a trade all the way. And so what they like to do is say, I'm going to set up my stop and my target, and they're going to be the exact same distance, because I don't know which way it's going to go. But my whole idea is I'm going to let it keep going. And the way I'm going to do that is I'm going to take half of my position off. So let's suppose I go out there and I buy 2 standard lots of the euro. I go long. If in fact it goes in my favor, then if I risk 20 pips on one side and I'm targeting 20 pips on the other side, then if in fact it goes 20 pips in my favor, great. I'll sell the one standard lot and let the other standard lot keep going in my trade. So I'd reduce my position in half. That way, I kind of like make this guaranteed degree of profit, and then everything else is just gravy. And I, psychologically, it's easier for me to let that trade run. And if you have a hard time trailing stops and kind of moving things up, that is a fantastic strategy. Now, statistically, it's bad. Mathematically and statistically, it's bad strategy. And I'll explain why. If you're risking, the example I gave was 2 standard lots. If what you're risking is 2 standard lots and it goes against you and you get out, great, you make whatever loss. And if it goes in your favor, you make whatever gain. Those two offset each other, right? But if what you say is, for over the duration of my trade, I'm going to have 1 or 1.5, I mean, however you want to measure it, if I'm winning, but I'm going to have 2 if I'm losing, right? Then your biggest costs occur when you're wrong, and your smallest opportunities occur when you're right. You see what I mean? It's like if I risk, if it keeps going further and further in my favor, I want to get more and more and more opportunity if I can. That particular principle mathematically is correct, but psychologically it's super hard. So if in fact you can't do it, it's not the case of, well, here, I could have made 50 or 100 or 1,000 pips. Well, I could have, should have, would have. If mentally that throws you off your game and you can't do it at all, and you pull the trigger early and you make a loss because you're too freaked out about the size or something, right? Well, then if your alternative is make nothing or make something because you use this technique of scaling out, right? Well, then great. Scaling out's the better one, right? So the idea here is that particular thing is a psychological benefit. It is psychologically easier to win and to profit making that kind of trade. Mathematically, it's a little backwards, but hey, if it's the only way you can make it, then do it, because it's a whole lot better than just having rigid stop and target amounts. So psychologically better. Now, if you get really used to it and you say, look, I know I'm going to play this game where I am going to move my stops, and sometimes I'll see the price move away in my favor and then it comes all the way back, and that's where I get out. And I am okay with that, right? Until you can get to that point mentally where you say, I'm okay with leaving something on the table, then scaling out is probably a really good way to do it, because trend following and trailing stop kinds of behavior, that's what you have to do, is be okay with not selling the top tick, the very best price you can get, right? All right, so one of the trends that I think is sort of underplayed over the year 2023 is the US dollar Japanese yen. I'm just surprised that this carry trade isn't rocking and rolling. That is just, I mean, it started to back during this time when interest rates in the US were, very obviously rising. And you see, this huge move, right? I'm surprised that isn't continuing. And so it tapered off, started going up recently here, but because, hey, Japanese yen is still paying a negative interest rate, and the US Fed is paying over 5%, right? So that should be a great carry, just a no-brainer overnight carry for a lot of big banks. I'm sure it is. So there should be a demand for US dollars in relation to Japanese yen. However, that demand isn't translating as strongly as it had been in the past. Back here, people didn't know how high the Fed was going to raise rates. Now they feel like they do, and it's not all that high. And yet, if it isn't all that high, then, I mean, if you don't like it, then why did in the last day, why did the dollar jump so high compared to yen? So you remember, markets like certainty. They don't like uncertainty. Here, I think the Fed got a little bit, the Fed's behavior gave a little bit of certainty to the markets, because it was kind of like they said, yes, we know what we're doing, and we feel like we did it right. And this is the market's way of saying, oh, well, if you gave us such a clear signal and you're going to continue to behave that way, we like that. We like to know what we're doing. And so, in we go. More investment money going into this particular asset class. And so when I say carry trade, I mean, a large bank which buys the euro or the USD yen, right, or any pair against the yen, but the US dollar yen. Large banks, they want liquid. They don't want to try to do this with more exotic crosses or something. Instead, they're going to look at this and say, hey, we can park a bunch of money here, and every night get that differential head put in our favor just by holding the US dollar against the Japanese yen. And if they're going to do that, and if they're going to show more desire for that, then you would expect this thing to continue to increase. And look at where we are right now, right there at this level. The last time we were at this level, we came down from a much higher level in a single day very rapidly. So we could move from 142 to 146 on this US yen pair rather rapidly. We could see a really strong upward move. Now, maybe the first 2-3 days of the week aren't going to go very far, but if all of a sudden they break higher, then yeah, you could see a really strong move. So let's see if we can use Catherine's idea there that she gave us. And I mean, I'm sure some of you have heard that kind of thing from a lot of people. I'm going to get rid of the Keltner channels here. They make for a good indication of understanding how far things have moved, but let's keep the chart a little clean and a little clear to sort of show this. See, here is a 1 hour chart, and you can see what's happened is we were on the US dollar yen moving along in a kind of sideways channel, and we've started to move higher now. We're not moving in such a sideways channel, or at least we weren't when the markets closed last week. Now we have made a decided upward move, trending higher there. Okay. So I say, all right, the bias, the default is to the upside. I'm going to watch over the next 3 days and see if, in fact, I can pick out a range. So maybe at the end of Wednesday, I just do this same thing. I just draw the top and bottom lines of whatever range it is, anticipate a breakout. And maybe it's going to look something like what it did this last week. All right. So how would I trade that? Well, if in fact I'm watching this and it's sideways, and then I see this breakout, and I see it continues on a little more the next hour, so much that it's not looking back, it's making a new high, at least for the first few minutes of that hour. You know what? Okay, I'm ready. I'm going to take this. What would I do? All right, I would enter here, make that blue for my entry. Now I'm going to set my stop loss. Where am I going to set my stop loss? It doesn't matter a whole lot so long as you know where you want to go on the other side. That is to say, if you want to risk one to make one, that's a 50-50 trade. If you want to risk one to make two, I'm only going to win at 33. I'm going to lose at 66, right? If you risk two to make one, then I'm going to win at 66% of the time, but I'm only going to get a small win size, right? So which one of those three kind of do you like to try to work with? We're talking about a 1-for-1 in this situation. I would love to know that my stop should be right there so that, I could hang on and then I could get that much profit on the other side. But I don't know the future. And I can't pretend that I do know the future, not if I'm a good trader. Even if I do think I know the future, as a good trader, I will tend to do better if I behave like I don't, if I pretend like I don't know what the future is. Okay. So here's what I'm going to do. I'm going to look at either the trend distance itself, this one and this one, right? That's the channel. So my stop loss is, back down here, right? I'm going to take that whole channel. Or I'm going to say, well, we did get a higher low, so I could go here. And that's most of the channels. Those two stop losses are effectively the same thing. Or I'm going to look at the average true range. Time to bring the Keltner channel back on here. So if I look at the Keltner channel, this is a 10-period length and a multiplier of 1 that I'm showing you. If I look at this this indication and I say, what is the distance from the top of the Keltner? At the time I'm looking to make the trade, which is going to be right here. What is the top level there? It's 142.267. And what is the bottom right at that same amount? It's going to be right there, 139.769. So, 140 and 139.7. So, you got about 25 pips there, right? So, I could say I'm going to, based on just the average true range of a 1-hour bar is about 25 pips. I could say I'm going to set my stop loss 25 pips lower. That's this one right there. Than where I started. Let me see if I can get that even more precise on this chart. Price range. Yeah, that's looking more like 40 pips I got there, and I was saying 25. Let me try this again on the. Yeah, actually, so if I go from the top of that channel to the bottom of that channel, it's more like this 49.50 pips. I was saying 25, but just visually looking at it, it's more like 50. Let's see what we get if I go here. So that's interesting. See that's just that one ATR. yeah, sorry, this band is 1 ATR up and 1 ATR down. So this distance is 2 ATRs. So that 2 ATR is just right there, just enough to get, sort of nicked out in this kind of setup. And, in hindsight, we could look and say, well, I'll just go a little more than 2 ATRs. It's not a good idea to play that game. If I'm looking at this, I can recognize that for this particular trade, it wouldn't have worked. In that trade, it would have worked very well. If I had said, okay, how far back am I going to go? I'm going to go here. Something like 115 pips or 113 pips, something like that. But let's go look here at this 50 and look at how we're going to plan the trade if we had used that. Now, maybe it would work. Here's what we would do. See, we would plan to get out with a profit at 50. We'd stop at 50 and we'd target 50. All right. If in fact it took off, instead of getting out at 50, what we would do is sell half of our position, close half of our position, and let the other half continue to ride. And then if it comes all the way back, it's just a break even. It's just a scratch trade. We didn't lose anything. By selling out here, we locked in all of our potential gains that we need to eliminate our risk. And the rest of the trade is just a free ride. Well, here, if I got really smart somehow and just clairvoyant, knew, take your profit here, close out the trade, I'd be feeling really great over the next several hours. But if not, it's going to come back down and it's just going to stop me out very frustratingly on this particular trade. This is actually pretty good methodology to trade the 2 ATR for most time frames. Here, it just, it happens to really be a frustration. But using this methodology, psychologically, you don't have to worry about getting, cut out at the last little bit. So again, psychologically, this is a fantastic way to trade. So much so because look, here it goes up, you come back, oh, darn, I thought it was so promising. But then right after you get ticked out, boom, up it goes again. And you get the opportunity to come back in at that same price and say, I'm going to try this again. This time you go up, sell the half, and you're still running today, right? So, I mean, psychologically, this would make it a lot easier to take this disappointment and respond by getting right back in. If you're doing it the other way, where you're saying, I'm just going to let it run and move that stop higher and higher, well, you might not get a chance. You might get, this sort of small trade, and then here, you're moving it up and or maybe it was so disappointing you didn't even take the second one. So you have to sort of look at you and say, whoa, what kind of trading methodology am I looking at? All right, now, wherever this support and resistance channels appear over the next several days, then you could try to set up a breakout of either side, going long or short. And it won't matter which pair you try it. I think that this will appear on almost all pairs, if I'm correct about how the week's going to play out. So that's something you can do to get ready to make a fantastic trade this week, and decide for yourselves. If I've done this sort of thing before and I'm used to this 1-for-1 scaling out, I know how it works. Great, do that. If you're brand new to it, but you're a wolf trader, risk 2 to make 1, you like to win a lot, I wouldn't bother trying to trade. Wouldn't bother trying to trail it along. Maybe just not much, maybe about 10%. So instead of a risk 2 to make 1, make it a risk 2 and try to capture 1.1 or 1.2. Just something a little bit more, and let that be your edge. Every time you trade, every time you try to do it, just try to take just a little bit more for this coming week, right? And then in the case of the Jaguar trader, or risk 1 to make 2, right? Then just, if you're patient, you know how to do that, then you don't need to scale out. You take your trade and let that grow if it will, because I think we'll see a real trend emerge towards the later half in the upcoming week. All right, I got time, maybe just a couple of minutes for any final questions if you have any. And yeah, so Catherine, you're welcome. You're welcome. Is it prudent risk management to pocket something first? Again, psychologically, it's prudent, right? What does prudent mean? Prudent makes you feel like, hey, I'm doing it right. I'm being a good risk manager. That's a psychological benefit. I mean, a good risk manager is what allows you to protect your capital over many trades in a sort of systematic way, so much so that you trust the system. That's for where trading is concerned. That's where good risk management comes in. But until you can fully trust your system, then these psychological benefits can be a good way to make money until you get there, right? Yeah. Excellent, Catherine. Glad to know that works. Richard, yes, you're welcome. All right, everybody. Hey, have a great week. Enjoy the sort of calm, mild seas for the first 2 or 3 days, because it's going to get bumpy. You better take your Dramamine. This is not going to be an easy cruise through the end of the week. So hopefully you can plan your trades and trade your plans and profit from the turmoil that's likely to roil the markets later on in the week. Until next time, everyone, take care and trade well.